The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed.
Welcome to Stocktake. My name's Gaurav Sodhi. Joining me today are analysts James Carlisle. Welcome, James.
Good morning.
And from Vancouver.
Vancouver.
From Vancouver. That's the name of the city, right, Graham?
Yep.
Right. That's where you are? Yes, okay. I'm sure we'll fix that in post. Well, all the way from Vancouver is Graham Whitcomb. G'day, Graham.
Hi, Gaurav.
Our producer's not going to fix that in post, is she? She's going to leave it in there and...
Well, she'll have to fix it now. You're rattling on about it.
Yeah. I think I should have to. Okay. Yeah, you better save me, Stephanie. Right, gentlemen. Don't know what's been happening with you, Graham. You're probably sitting there in peaceful, serene snow or in beautiful weather, but we have been having it over here. JC, how are you doing with all the water?
Oh, it's pretty crazy. I've had siphons, hose pipes going in the garden. A flower bed filled up with water. Geez, I sound.
Yeah.
I mean, compared to how.
Yeah, I know. I was going to say that.
I shouldn't be worried about my flower bed, should I? But,
it's a disaster.
You know, I had a puddle under the house in the cellar. No, look, it's pretty. I'm sort of up the hill here, so I'm all right. But geez, it sounds pretty bad for a lot of people. So
yeah,
hope everyone's okay out there.
Agreed. Yeah, a lot of the roads around us were flooded. The Rosewood Bridge was completely closed, so pick up and drop offs were quite tricky. But it's been difficult. All the streets around our area are flooded as well. Somehow our house is actually above water, but we've got roof leaks. The garden just can't take any more water. Huge puddles everywhere, and everything is just so soggy. It's just an awful place. I'm dying to go into the office actually and work somewhere dry, but it's really gross. Speaking of yuck, gentlemen, the market's pretty interesting. How are you guys handling this? There's big falls in pretty much everything. Although, look, I must say, coal and energy has held up pretty well, which is sort of half my portfolio.
Well, it shows the benefit of that diversification, doesn't it? I never have any resources stocks, and at times like this, I sometimes wonder whether I should start because it does provide a bit of a hedge, doesn't it?
Well, I look, I don't want to boast really, but I will a little bit. I mean, the reason we've got, look, I think we distinguish. We're quite different to most value services and funds. It's because we have resources exposure. I mean, Nathan's, I think, wrote the fund updates a couple of days ago, and those funds are chock-a-block full of miners. Probably a third of the funds are now filled with miners, and there wouldn't be too many value investors who could say the same thing. And I think that's the way it ought to be. I sometimes get very frustrated with traditional value investors and how dogmatic they are, and it's almost a pious enterprise, about who can be the most preachy and who can adhere to the rules the strictest. And I just think the best investors are actually the guys who know when to break the rules and when not to adhere to them.
Well, they were showing a fair bit of value as well, weren't they, last year? So while everything else was getting a bit carried away, they were showing a bit, which is hence why. I mean, I don't think we necessarily got into them for a hedge in case Russia invaded Ukraine. But if
I did know about it.
Well, yeah. Well, Vlad gave you a call, did he? He gave you a heads up. But no, look, I mean, you saw that the commodities were pretty cheap, and the stocks were pretty cheap, and so look, you buy the value, but it certainly helps to have. I mean, they respond differently to different macro things, while everything else is tanking. They've been doing pretty well.
I just think I've been saying this so much in podcasts and in the office and anywhere I can, but I just think investors ought to be flexible and open-minded. And this idea that we only do this or only do that, and a very narrow view of your investing universe, I think is a real problem and can be terrible for your returns.
Yeah, you got to look for value wherever it is. You can't just say, "Well, my bit of the market is not showing much value, so I'm going to sit in cash." You do have to hunt around for it within your circle of competence, but I think you've got to, as you say, be flexible.
Yeah, it's a tough balancing act. But Graham, how have you been holding up? How are your stocks holding up?
Well, there've been a few big falls for them. Ansell kind of got the party rolling at the beginning of the reporting season. It's
Yeah.
now down. It's just about halved from its high last year,
Oh wow.
uh, which has it's been an impressive um, decline, but maybe not totally unexpected that it would, or at least that sales would come down as they have. Um, they've had some issues with just. I think they were one of the first ones to feel the pain of the bottlenecks in supply chains. They have a lot of shipping moving around. That
Mm.
kind of got clogged up. They had this double whammy where people were pulling back on purchasing personal protective equipment and gloves, while at the same time, supply from competitors was increasing because every man who owns a factory has basically opened a glove supplier this past year. Um, they kind of got stuck in the middle of a few different forces, and that caused margins to really tank this half. But
Yeah,
a
it
lot of
was it
that,
was a
it's still the decline still surprised me because
mm,
I mean a lot of that was expected. It wasn't you. I don't think many people expected glove sales to continue as they were in the middle of the pandemic, or for other suppliers to not increase capacity or anything like that. So although all of the although its kind of operational performance doesn't seem very surprising, what has surprised me is just how badly the market took it.
yeah. I mean, there have been a lot of stocks that have fallen 50% or more, but I was surprised to see Ansell on that list. It doesn't really fit the narrative of high growth, high multiple, unprofitable business. It's quite the opposite of all those things. Pays decent dividends, low multiple, and
Yeah,
pretty steady. So
and
I'm surprised to see where it is.
the surprising thing is also that it's back to basically where it was before the pandemic even started,
Hmm.
despite being probably a big beneficiary of it. That there probably will be at least some perpetually higher demand for personal protective equipment because a lot of hospitals will kind of increase their purchasing long term due to different guidelines being changed. People in general are probably a little bit more hygiene aware and so more likely to buy or stock up on gloves and that kind of thing. So
Hmm.
I'd expect that its sales to be higher post, like even if all of this disappears in terms of the current strains running about, I'd still expect Ansell to have higher sales than it did going into the pandemic. Uh,
Yeah.
and yet its share price is kind of below it where it was before.
Well, we're also coming to the end, I think. So I guess we've finished now, but reporting season is over, and Ansell might be an interesting one to cover off a little bit more with a little bit more detail, Graham. But before we do that, can we get some general impressions of reporting season? Because we cover different universes, really, and I suspect my experience of reporting season may have been different from some of yours because my company's absolutely. I probably
Yours went
saw some of
up.
the best results.
Yeah, mine didn't go up.
I saw probably some of the best results I have ever seen. Those miners have been astonishing, and I've seen plenty of booms before, but this one was special because the cost work and the productivity gains that have been achieved over the last 10 years has really paid off in this reporting season. And the capital allocation across the board, across any sector, any metal, any business, it is now the norm for these mining businesses to take a lot more care with capital allocation, and they're rewarded for good allocation now by the market, and they're punished for bad allocation. Big change from the last boom, where prudent conservative miners were punished, and those going off buying everything were richly rewarded. So this has been a massive change. And I've been saying for a while, I think this is a more permanent structural change across the industry. And this result certainly bears that out. So I've had a great reporting season. I've been shocked, amazed by some of these results. JC,
Well,
yours
yeah,
would have
I'm
been,
probably the polar opposite. I think
yeah,
because
would have been a bit tougher for
I've got
you.
a lot of the sort of high quality, high growth, highly valued stocks,
Yep.
and they're being absolutely smashed at the moment. So
Mm.
you look, I mean, some of the results no, I think they were mostly pretty good actually.
Yeah.
Domino's disappointed. We'll talk about that in a minute, but
Mm.
mostly okay, but there's just no appetite for some of these high growth, highly priced stocks at the moment. Um, and at the smaller end,
Mm.
they just seem to keep grinding lower. It feels a little bit like, not quite as bad, but it feels a bit like the original COVID crash in March a couple of years ago, when I think the brokers used to call it a buyer's strike, and when there's no one who wants to buy a stock because people see the stocks going down day after day, and that people, a lot of people are sort of maybe not chartists, maybe not following momentum, but it still puts you off buying a little bit, and yet there's still constant sort of selling pressure because people want to raise cash or they get frightened or whatever it is. So that sort of supply demand imbalance is only one way, and stocks keeps grinding. A lot of them just keep grinding lower, and um, it's an interesting question on how to play that.
Mm.
Well, I mean, I think there's only one answer as a value investor. You just have to
Day trade.
buy the value, grit your teeth and buy the value. And of course, but what it means is you do want to do it in parcels, because
Mm.
there's every possibility of that value getting better. And as that value gets better, it's appropriate to have a slightly higher weighting in the stock. Um, I think buy in parcels, grit your teeth, and have some resources, so you can sell something to buy it.
And also just be anchored to the valuation itself, that rather than
Yeah.
watching the
Mm.
share price too much. Just
Well, that's what I'm trying to get across. But I think that the point is that you'd be surprised. I'm constantly surprised at the opportunities that get offered up. I mean, just going back to the COVID crash, for example. I mean, you got Lovisa and Ordinate, for example, with
Mm.
in the $2, I think, didn't you? At one, I mean,
Yeah.
things can get really extreme, and so if it's possible, you want to leave a bit of spare capacity for those sorts of eventualities if you can. You don't want
I
to just go
remember
all in where the value is just slightly attractive. You want to give yourself an option of something better.
I bought my first parcel of Lovisa shares around $10, and I saw that fall all the way to $2 something. I think I bought a parcel at $3 something, and I was just thinking to myself that that's the largest spread of buying parcels I've ever bought, from $3 something to $10 something.
Yeah,
Uh,
or $10 to $3.
well, yeah, that's probably
Yeah,
more accurate.
but
But
that $10 has proved pretty good in the end.
yeah,
So
and the $2 has been
yeah,
that $3, sorry, has been spectacular.
yeah,
It just shows that these things can move faster and lower than you might expect, but they're
yeah.
not always
It's
representative.
particularly the illiquid stocks. So those are the ones
Mm,
to watch out for, because look, some days no one turns up who wants to buy them,
mm.
and if that's the case, then someone turns up who really wants to sell, then the price is going to fall.
This does feel different, though, to me. March felt very indiscriminate, and we were having big drawdowns
2 years
every
ago, you mean?
day. Sorry, yeah, two
Yeah,
two years
yeah, yeah,
ago,
yeah.
yeah, 2 years ago, it
Oh,
felt
it is different.
indiscriminate,
It's not as bad.
and
Yeah,
yeah, whereas now I think it's quite targeted. The stocks that are selling off, there are a specific subset of stocks. It's the COVID winners and the unprofitable growth stocks.
mm.
Mostly are the things getting hammered. I mean, I've been sitting here waiting for PWR and John Ling's group, two stocks I think are very interesting, sitting there waiting for them to sell off, and they just won't budge. They won't go down. Huge multiples, both of them, but they don't quite fit that narrative, and so they've been spared.
Well, I think when you get a correction in certain pockets turns into an all-out sort of crash, what happens is the selling sort of moves to the higher quality stocks, because people start wanting to sell some of those in order to take opportunities elsewhere, and
Mm,
so the whole thing starts grinding low, and we haven't quite got to that point, I suppose, and who knows if we will. I'm not
mm.
trying to predict anything, but yeah, as you say, at the moment it's really just my portfolio. So, some days it feels like that anyway.
And Graham, what about you? You've got quite an eclectic collection of stocks there. How did you find reporting season overall?
I found it very random, the movements. Some of the stocks that I cover definitely fall into the groups that James and you just mentioned, but there are others that seem to have just the market just, I don't know, didn't like their results, didn't like something about them, and I'm seeing movements that just seem random almost. Normally, I feel like in a reporting season, you can kind of predict once you see a result what the stock is going to do, at least the direction that it's going to go. But I feel like
Mm.
this reporting season has been so all over the place that when I thought a stock would jump after the result, it went down, or other times it went down twice as much as I thought, or yeah, it just seemed to be very erratic.
I'm finding that increasingly the case. I often, I find myself getting increasingly surprised by the magnitude of movements in reporting season. We'll talk about Lovisa, I guess, a bit later, but that thing rose 30%. And I remember looking at the result in the morning thinking, oh, it's a really good result. It's pretty good. It's probably going to be up a couple of percent today. It's up 30%. And Graham, you've got I forget the name of it, but it's a vitiligo treatment business. What's it called again?
Clinuvel?
Clinuvel, yeah. I
Yeah, they
looked
don't
at that
actually treat
result.
vitiligo just yet. That's in their
Right.
pipeline
It's
as
in
a
their pipeline.
potential
Okay.
treatment. Yeah.
Clinuvel, yeah. But I looked at that result and I thought that looks pretty good. This thing will probably do well today. And it had a massive fall, and I just didn't understand that. MoneyMe was another one where I thought the result was outstanding, actually. And they got clobbered on the day. And since then, I don't
Yeah.
quite get that either.
MoneyMe has surprised me a lot. I feel that it could be a case of just over expectations, that it is growing at such a speed that even a small decrease, if you're some investor who's thinking that it's going to grow at 20% a year and it ends up putting out a number of 18% or something or other, that's going to swing your valuation quite a bit if you then project that out 20 years. So yeah, I get the sense that it's a product of its ultra high growth and not having let the market down very much, that yeah, just a slightly less rosy outlook than people expected kind of walloped its share price. But it had a great result. I think it was one of its best results yet, just not only in terms of the numbers, but just management's engagement, and I don't know, I came away with a very good impression.
Yeah, I think that management's actually very good at presenting and quite charismatic, because every time I hear Clayton Howe speak or present, I just want to go buy some more shares.
Yeah,
He's
I'm the same.
he's very engaging, and just that growth. Well, why don't we do that, Graham? Why don't we actually turn now to some detailed results? We all bought a couple of interesting ones along, and I think, is MoneyMe on your list, Graham? It is, isn't it?
In terms of, I mean, I cover it,
The
yeah.
one of the results you're bringing along to us, along
Oh,
with
I
us.
think Ansell might be the more interesting one for now,
Okay,
just because not as
let's
many
switch
members would
to Ansell.
own MoneyMe as Ansell, I'm guessing.
Okay.
Yeah, so I spoke about it a little bit earlier about what it's going through at the moment, but I mean, it looks like great value to me, despite all the falls since kind of late last year. I mean, this is still a company that should be able to grow in line with the economy over time. It's not as if 10 years from now gloves are going to be displaced by some internet startup or something like that. It's the largest producer in the world. It's got all these economies of scale and extra
What's
things
the
going
market
for it.
share? It's quite low, isn't it? It's got big competitors. It's in the sort of 10 or 20%, isn't it?
Yeah, it's
global market
it's not
share.
a dominant share, but it's still kind of mostly an oligopoly of just maybe five large
But it
manufacturers.
relies fully on. I mean, there isn't much sort of differentiation in a glove. I mean, I suppose in certain areas they'd have specialist sort of gloves and stuff, but generally speaking, it's really the scale and the economies. Those are the economies of scale that gives it the competitive advantage, and it's none the worse for that, I guess.
Yeah, the economies of scale are where probably the most uh, enduring competitive advantages. It's almost impossible to think that a small glove maker is going to compete anywhere near their level of distribution network or just the plain um, economies in the factory. But they have been shifting their product portfolio over towards more branded gloves, the niche areas. They do have a big single use division, which is where kind of the losses over this past 6 months were originating, just more generic gloves. They also have some that are outsourced to other manufacturers. That got squeezed as well. But yeah, a big part of their industrial division is a very niche branded gloves for specialized uses, like
And
some particular chemical they're resistant to or something like that.
and those would have would have higher margins, would they? So that they're disproportionately making profits, are they? And perhaps a little bit less cyclical.
Yeah, it's not a high margin business in any area, but those gloves do make better margins and better returns on capital than the rest of it.
Graham, I'd always assumed actually. My thought on Ansell was that it is a relatively low margin business. And I know there are big competitors, but the gloves themselves are an interesting category because they carry a high proportion of risk but a low proportion of cost. So if you're a manufacturing business or a medical business, gloves are so important. The quality of the gloves is so important. And if something happens, something goes wrong with those gloves, the consequences are so dire that it's probably not an area you risk switching around too much if your current supplier is working.
Yeah, and there's
And so,
also an element of, because they're used repetitively throughout the day, if you're a surgeon or
mm,
something, you're going to be using the same glove over and oh, well, not the exact same glove, but you're going to be using the same brand of gloves over and over. If you're some chemical engineer or something, then you might be wearing the same glove the whole day. Because of that level of usage, even a small difference in the quality or the comfort or flexibility or anything like that is going to make a difference to you, because
mm,
if this is something that you're wearing constantly, then you're going to need, or you're going to notice, the slightly better brand and that kind of thing. Particularly
mm,
when you've got distribution networks that are running through, say, some big purchaser at a hospital or something like that, where they're going to only
yeah.
buy from that one brand or uh, one distributor, then yeah, those little differences. I mean, I don't think Ansell's gloves are going to be twice as good as the next guy, but even if they're just slightly better, that can accumulate over time to a pretty loyal base of users.
I had two questions about Ansell, really. One of the first one is actually quite a tricky one, Graham, and I hope you're able to enlighten me. But historically, Ansell in its results has had a lot of abnormals, one-offs, extraordinary items, and there's always seems to be multiple lines under the under the bottom line of one-off events that it change or influence the results. Is that now at an end? Are you happy with the way the company actually reports its results?
Uh, yeah, I mean, they usually need some level of uh, change, but I don't think, I mean, it hadn't stood out to me as being one that has too much going on beneath the profit line. I mean, they've restructured a bit over the last 5 years. So, yeah, there's going to be changes in terms of some operations have been sold, they've made acquisitions in other cases. So, those, I mean, that's pretty normal to then write off acquisition related costs or discontinued operations or something or
Mm.
other to get taken out. But doesn't strike me as a company that is, I don't know, manipulating numbers somehow.
Okay. Can you say something about capital allocation as well? Because the dividend yield surprised me a little bit. Just how high the dividend is on this business. Is that sustainable? Are they running with too much debt to cover that, or what's your view on how they're spending the cash?
I think they've done a very good job, really. They earn pretty consistent returns on capital. I mean, it's nothing spectacular, but in the 10%
Mm,
range or so. Uh,
mm,
and management's been pretty good. I think the best thing has been that they have been willing to let go over the last 4 or 5 years in particular, the lowest margin, generic elements of the business. They sold the sexual wellness division a few years back. They've cut out a bunch of brands. They've consolidated a bunch of other ones under new brands. So I think they're moving in the right direction. It's just a slow grind, and I'm willing to give them the benefit of the doubt. They've been a pretty good management, I think, over the past 5 years. Nothing's
mm,
jumped out as being, um, I don't know, that it's poorly managed. But I think they've had a lot of. They've just got a naturally volatile business. They operate in a lot of countries. A big chunk of their
yeah.
earnings come from emerging markets. They're also in very cyclical industries such as industrial or automotive, or now we're finding healthcare. Uh, So there's going to be like this is a stock where you're going to get big booms and busts in earnings generally, but over a period of 5 years, I think management's done a pretty good job overall.
Yeah, no, I would actually agree with that. 'Cause I think this is a really difficult business to manage. Some companies are easier than others to manage. This is really hard. You got variable input costs. You got a huge distribution network to manage, a large product range. It's and a big bunch of competitors as well. So it's a hard business to manage, definitely.
Yeah, I agree.
JC, any comments on Ansell before we move on?
No, I think you've pretty much covered it.
All right, your turn now, JC. What do you have for us?
Well, I was going to mention Domino's, which look, it was a pretty poor result in terms of what had been expected last year. I suppose it's really the turnaround from a year ago. Sorry, 6 months ago, the full year result when Japan, well, and a year ago when Japan was just absolutely firing on all cylinders.
Yeah.
And then suddenly it kind of fell in a heap in October. So the second quarter of the year, Japan sales in Japan fell. Same store sales fell 12% in the December quarter, compared to quite a strong period. But that's a big fall after the state of emergency lifted, and so I think the thinking is that more people eating out in other restaurants and not getting so much pizza delivered. And so that's a big shift. And the margin fell also from 14% to 10%. So a real crunch. And 6 months ago, the market and we were singing and dancing about how well Japan was going. And so, that the stock got a bit ahead of itself really on all of that. People were extrapolating all of that. I mean, it got above our sell price, and I was desperately sort of hanging on because it's a quality company, and you don't want to sell it. So we didn't. Hindsight's a wonderful thing, but now it's fallen all the way back. All of that froth has gone off, disappeared, and well, I say that it's on a price earnings ratio still of 40, which is pretty high. but
it's now just a cappuccino rather than
yeah. And I mean, earnings are going to fall this year by a few percent. But look, we the management described that as a rebasing, which is management speak for start. It's all starting again from a lower level. But that's probably fair. It's still a high quality business underneath. Japanese sales and profits got a bit ahead of themselves, but I think the company can move forward from here, and growth over the next couple of years should bring that multiple back into the 20s. The other thing is to bear in mind with Domino's is that it's it is quite well diversified now, because while Japan did poorly and Europe is still performing very well. The performance at home actually in Australia and New Zealand wasn't the greatest. They're investing to try to get franchisees to take up Project Ignite, they call it, to take up stores in underpenetrated areas. So they're sort of handing a bit of their margin over to franchisees, but those are their best franchisees, and they're trying to get them into better into new areas and open more stores. And so I think it hopefully eventually will drive sales. That's the balance they're striking. And so it swings and roundabouts. And while this was very poor in Japan, Europe still goes well. And they're talking about, and Taiwan, of course, is going very well, which they bought recently. And they're talking about making further acquisitions. And the thought of this management team getting their hands on, another country or region is quite attractive. So, look, we like it. We still back it, and we're now prepared to buy it. So it's about $80 now, and that looks pretty attractive. I mean, like I say, the PE is still quite high, but this is a company which, despite the recent setback, is still should still grow strongly, we think, over the medium term.
If you look at this over a 2-year period rather than compare just last year's results or 3-year period, then where they are today is actually quite extraordinary. And I'm not sure we would have
That's right.
expected that 2 or 3 years ago.
No, that's right. It's the old 2-year stack, isn't it? It's a
Yeah,
classic sort of, when the last year doesn't look so good.
that's right.
I was looking at a result recently. I'm trying to think, was it Woolies or Coles?
Hmm.
One of them was talking about maybe doing a 3-year stack. So, but
in
yeah,
Domino's,
look,
I think
it's true. It's valid.
it's
Because
valid.
it's
That's
been a
right.
very
Because you've had
weird
this
period.
extraordinary COVID period. And it was hard to know at the time how much of the growth was one-off and how much was due to all the things that the business itself was doing.
Yeah, and it
Um,
does do a lot, and
yeah.
I suppose it's a credit to Domino's management that the results in Japan were believable as being inherent
Well,
to
that's
the
right.
business, as opposed to being fed
But
by
that's still a ripper
other brands.
territory, Japan. I mean, this is by
Yeah, oh,
no
it
means a
is.
problem
Yeah,
child,
yeah,
and
and
they've
they're
got a
still
long
putting
runway.
out new stores, and they're
Yeah.
still building, so opening new stores. So look, I think that there's a long runway ahead there. The European Japanese market's relatively underpenetrated compared to Australia.
And they've still got growth in Australia coming too. There's
Yeah,
still additional stores to open
yeah.
in
One
Australia.
thing they pointed out, they were quite big on in the presentation, was that especially in Japan, the number of stores, um, so people with franchisees with 6 or more stores, has almost doubled over a year. Well, actually, it's more than doubled over. Oh, actually, no, just almost doubled over a year ago. So 16% of stores are now with people with 6 or more stores. So they're getting their best franchisees are
Mm,
opening new stores,
mm,
and that bodes well for the future because they're the ones that make the money. So
mm.
um, I think it's well set up, but it's taken a step back, and that's the opportunity. So
In this environment, this is a dangerous thing I'm about to say, but I actually think 40 times isn't a silly price to pay for
well,
Domino's.
it's the new 20, isn't it?
There aren't too many. How many businesses are there that have such a reliable growth runway to come? And these
Oh,
guys are going to
I
at
could
least
I could think of
double.
a couple,
I don't know.
But how many sell
These guys have
pizza?
the
yeah, that's
and
right.
and
I
look at the
mean,
track. I reckon this is one of the best management teams going on the ASX. I have so much respect for the management and what they've done with this business.
yeah, I think
Um,
growth in the teens for quite a few years
quite a
is
few
is
years.
very
Yeah,
very possible, and I think that brings the PE of 40 down very quickly.
yeah.
It depends. I suppose the other factor is interest rates and how much you want to pay for that growth.
Mm.
Um, if interest rates went up to 8-9%, then you'd probably see this multiple come back. But that's not something we look at particularly.
I know if everyone says that they want to buy great businesses when there's a pullback or when the market panics. Well, um, I reckon
Yeah, this is
Domino's
a classic case of that.
is
I
right up
think.
there.
Yeah,
Yeah,
yeah. I
as a
think it's
great business.
look, it's a setback, but the business is far from broken.
Yeah, yeah. No, I think it's quite interesting. Nice one, JC. I'm going to mention Whitehaven for one of my stocks. It is now my largest position in my own fund, but that's not why we're talking about it. We're talking about it because when the result came out, I thought it was a ripper result, and I was speaking to a friend of ours right afterwards, and we were sitting there sort of gleefully thinking about, oh, look how much the stock price is going to rise on this. People are finally going to
Gleefully.
see. Yeah, we
Wow,
were giddy.
that's
We were
good.
giddy. Off
I
and
think
I.
gleefully would normally be how you look at it. Sorry,
Hey,
I didn't mean
you can't help be the editor,
but
can
I
you?
love it. Well, I love that word, gleefully. I shall use that later.
I think it's good. Yeah,
Keep going. Sorry.
I'm making all these improvements to the language you don't recognize. I'm eliminating apostrophes. I'm adding amendments. but it was actually the stock actually fell quite heavily on the day, and I just couldn't understand it. And I still think where spot coal is, even the future price of coal, the entire structure of that future curve has moved. We're not just talking about a spike in the spot price. Um, Contracts for coal months, about 12 months in advance, have all shifted dramatically higher. I've never seen the coal price like this. The thermal coal price is now sort of $450 spot, and Whitehaven produces at $80. And in my assumptions, I thought it would be like 120 Australian. So I thought it would be maybe less than $100 US, and we're now talking sort of 400, 450. The numbers, when you run them, are so ridiculous. You want to be just careful because at spot. Now, look, I'm going to insert a little warning here. Just be careful. Just sit down and think before you do anything when I say this, okay? But at spot, Whitehaven will probably earn its market cap in 8 months.
Reason to
Or
be
it could.
ghoulish.
Yeah. Now there are caveats there. One is that there's lags associated with the price, which actually in this sort of environment means that we're going to see the second half be an absolute ripper, and probably the half after that, or at least the quarter after that, is almost guaranteed to be good. But $450 thermal coal is obscene. It is not. I mean, no one should expect this to continue. I think it can halve and halve again.
So
Um,
who's paying those prices? Who's buying coal? I mean, who needs it that
Yeah.
much?
So what's going on, right? Okay. So what's going on is that when you build a big thermal plant, a thermal generator, coal is a variable cost, but it's by no means enormous. And
Compared to the cost of building the thing in the first place. So your
and compared to
depreciation
the cost
charge
of
and
not
all
having
that.
anything to shovel in, that's
Yeah.
pretty
And
that's
shutting
pretty
it
big
down
too.
and starting it up and all that sort of thing. So you really want to
Exactly.
keep it going. Yeah, right.
So in the jargon, it's an inelastic demand curve, and the price can spike a long way if there's not enough coal. And what's happened is that this was happening before, well before the Russian invasion, but that's actually made it worse. But there's just a shortage of coal all over the world, as we've been saying for 2 years, that demand is remaining stable or even increasing mildly, especially in the region where Australia and Whitehaven specifically sell coal, which is Northeast Asia, and supply is stagnant. No one is building new coal mines in this part of the world. Certainly, high quality coal is hard to come by. The marginal supplier of high quality coal is Russia, and that might be a troubled market for some time. My own expectation is that I think coal prices could stay higher than people expect, sort of over around $200 a ton for quite some time, and it doesn't change the long term value for Whitehaven. So I wouldn't plug it into my spreadsheet at $200 or $300 or $400,
I bet
but
you have though.
just to see what
I
happens.
bet you have.
But
He's betting on 800.
Yeah.
every week that prices stay at this level um, adds to the cash that's going to be sitting on that balance sheet. And the cash balance is building, and it's building quite rapidly. And I think the best thing to come out of that Whitehaven result, the thing that really gave me a lot of conviction, and I bought more shares after the result myself, was that I was always uncertain about how Whitehaven would allocate its capital. This is a company that has uniquely among coal miners has a couple of growth projects that are permitted and ready to go. And I thought they may be tempted to pull the trigger on those projects, but they've pretty much been very clear. They're going to buy back stock. They're going to pay dividends. The debt's already gone. So this is cash is coming back, and it's coming back fast. And every single week, the coal price stays anywhere near these levels, more cash is coming back. And it's only going to be a matter of time before the market starts to realize, it's already tripled. Well, it's actually 4x since the first parcel we recommended, since the first parcel I bought. But I still think it could go higher from here. I caution that at this price, it's a lot of sentiment driving the coal price and coal miners at this point. So we'll see a lot of jumping around of stock prices. But this is not really, for me, this is not really a story about the stock price going up too much. It's really about just sitting on those dividends and waiting for the business to buy back more shares.
So has the business, or is the business planning to buy back a ton
Yep,
of stock?
already it's buying back 10% of its stock in 1.5 year result. I think that's probably what's going to happen from now on. It's probably going to start just buying back shares at every half year. In fact, the buyback started yesterday, well, Monday.
And it's doing that in preference to a special dividend.
Yeah, that's right.
And so management's saying, must be saying that they think the share price is.
It's on an EBITDA of sort of 1.5. So,
but management's saying it thinks that the prices are going to stay firm enough to make that valuation a reality.
Yeah, they did say they'd do it at effectively. They didn't say this, but they said they'd buy back $400 million worth. And 10% of the company, which is roughly at $4 a share. So, so that they're telling us that they're happy to keep buying up to $4 a share.
Do they own a big stake in the business?
Management owns a bit, a decent chunk, more than, enough to keep them interested. And they've got to be fair to them, they've actually got a really good record of capital allocation. What they've struggled with is operating issues from time to time, but that's a function of mining complex mines, and a lot of them. It's going to happen. But I actually think the management's quite good here. So I'm quite happy where Whitehaven is. Graham, let's circle back to you. We'll do one more stock each. Unless you guys have.
No. That's just. Gosh, everyone's frantically on their keyboard.
I'm putting my buy orders in now.
Yeah, I think. Bear in mind everything Gaurav said about the caveats.
Yeah, I know.
What's the portfolio limit on that stock?
Yeah, that's a good question.
Yeah, look, I think I've done it at 3 or 4%, and look, that's conservative. If you know what you're doing, you can make up your own portfolio limit, I guess. But that's to highlight that this is not without risk. I know the spot price looks very attractive, but as I said, that spot price is not representative at all of where coal fundamentals are, and I don't expect it to last. And they operate complex mines, a lot of them. They've had operating issues in the past. They could again. This is just in part of the market. I mean, Russia could come out, or Mongolia could come out tomorrow and say we're opening all these mines. China could do. There's a lot of X factors here that could influence how this might turn out. At $1 or $2, this was a very, I would say, you could easily handle all those risks. At $4, you just need to think about them a bit more. But there's still, I think, a decent opportunity here for a part of your portfolio.
You heard it here first, folks.
Well, you heard it 2 years ago, to be fair. Right, Graham, back to you. What do you got?
Well, we can talk about MoneyMe if you like. I mean, MoneyMe is a great little business. It's built this. It's got now nearly $1 billion worth of outstanding loans that it's built in less than a decade. So it's done very, very well in such a short period. It's also, one thing which I like about it is that it's managed to expand pretty well its kind of core competency, which is just getting loans out quickly to people. You can borrow money from this company in under an hour in a lot of cases, and it'll hit your bank account that day. But it's expanded that from just small personal loans. It's now gone into auto loans, and that's done incredibly well. Just over this past year, it's gone from a loan book of 0 to 155 million, which puts it on par with lots of other small lenders, and it's done that in a year. So
that's amazing. And
right,
okay.
That's done way better than I expected, actually. I was optimistic about the auto loan product. That was part of our original buy case last year, but boy, I did not expect that level of growth.
The company was saying before they even launched the product, they had dealers calling them, asking them if they could use it.
Yeah. And it makes sense. I mean, if you can get your car loan sorted out in less than an hour, then
Yeah.
that gets you out of the dealership quickly. It means the dealer can then focus on
That's right.
getting the
Closing.
next car out.
Yeah.
Yeah, so they've
No, I
done
agree.
a very good job, and all the numbers were positive this year, whether you're looking at the loan book or revenue or underlying net profit or whatever. Everything more than doubled, basically.
Graham, could you speak a bit about this acquisition of Society One? Because that looked like a ripper of a deal to me. I'm not sure if that's if that's correct or not, but and the market doesn't seem to like it very much for some reason. Can you elaborate on that a little bit?
Oh, what makes you say that the market doesn't like it?
Well, the stock price, I don't know, it's just fallen quite a bit since that deal was announced.
I
I
think, like
linked the two
everything.
together. Maybe it's not.
Yeah,
Maybe it's not linked to that.
I don't know. I wouldn't put it down to that. I think the deal does look good, and it's also because it's got an interesting way of lending. It's got this proprietary software that pumps out the loans and assesses risk apparently faster than others. I don't think that'll last. That's a lasting advantage, but they're doing a good job now for the next few years, I would expect. And Society One is a good deal. It pretty much doubles its the company's loan book, and there are economies of scale in this business that by having because it's got a fairly fixed cost base in terms of the operations, or they'll probably even be able to take out a bunch of duplicate costs from the business as well because they can combine head offices, they can use the same software platform to actually make the loans. I think it makes a lot of sense. It'll probably mean that they have, all things being equal, slightly better margins out of it, and they'll definitely get some kind of cross-selling opportunities in a sense where they can start pitching their auto loan product to the Society One members and all of that. So I think it makes perfect sense.
Yeah, and management's really impressive here. I am quite impressed with the way they're able to come up with new products, but thoughtful new products, not just a shotgun approach to offering everything, but really useful niche products, and they've all taken off. And they do that with a centralized kind of digital platform. So it does make it easier. And it seems to me that the more loans they make, the better their software should get at limiting losses, right?
Yeah, you would think so. I don't think it is going to be an enduring advantage. But the thing that impresses me about MoneyMe is that if you read the online reviews of this company, the customers or the borrowers absolutely love it. You just don't see large lenders that have so much support. It's almost got a fan base that you would see for a tech stock like, well, any of the different major tech stocks.
You
Except
tell
for
them,
maybe
Graham.
Facebook. Yeah. But they do have this loyal fan base, which is so unusual for a small
Customer love,
lender.
they call
Like,
it, right?
yeah.
Yeah,
But
genuine customer love. I noticed that when it reminded at the time. I think you had introduced MoneyMe. I was working on Aussie Broadband, and I definitely noticed uh, the management felt the same. The customer base had the same kind of love for the brand, and it's unusual in both circumstances to get that in those respective industries.
yeah, you do not borrow money and have to pay back interest to someone and then write this beautiful review about them.
Positive review. That's right.
So the fact that they've got
Mm.
like nearly 5 stars worth of thousands of reviews to me is speaks volumes of the product that they're offering and how happy customers are with the actual experience.
And may I say that management has hustle. Like those guys, you know, I
Yeah,
would
they're
back those guys
clearly
to make a buck.
strategists. They know
Yeah,
what they're
for sure.
doing.
Yeah. JC, do you have much to add on MoneyMe?
No,
Do
I'm
you
afraid
own the
not.
stock?
No, I don't. I've sort of looked at it, and every time I read Graham's reviews, I get interested, and then I think, oh look, I've got everything in my portfolio is so cheap. I keep trying to nibble at more of those.
Yeah, yeah.
I haven't gone that way yet,
Mm.
but it's interesting.
I actually own a bit of MoneyMe, and yeah, that's the
You should.
amongst all the coal and energy, and that's the big bright red spot in my portfolio at the moment.
You can borrow from MoneyMe, get the money in an hour, and then use it to buy the stock. And it's
Oh,
this,
okay.
Oh, now you're talking.
Yeah.
Now you're talking.
yeah, the safest way to invest.
And then write a positive review at the end.
Yeah, the circle of life.
Mhm.
Nice one. But just quickly on the valuation, just talk about how you think about valuing a business like this, because the PE is completely useless. You've explained in your previous reviews why that's the case. So, on what basis should one approach valuation?
Well, I think you do have to adjust what their profits are, because at the moment, a small lender that's growing really quickly, its accounts get completely distorted by this accounting
That's
principle
right.
called AASB 9, I think, by memory, where they have to record all of their expected loan losses up front. So if you're writing a ton of loans, as you're growing so fast, you're going to be recording mountains of losses in the first year instead of spreading them out over the full life of the loan. So all of these loans are being written profitably if you account for all the interest that's going to be generated over the full life of the loan. But that first year is just completely distorted, basically. So yeah, the current PE doesn't really matter, but you can get to the underlying profitability and then what you would expect over the full life of the loan. So that's how I've gone about valuing it.
Okay. Off the top of your head, do you have a figure for that at the moment?
We've got to buy up to 220, and the sell price is around $4 a share, which is roughly where I think its fair value would be.
Nice one. Okay, let's carry on. JC, what's your second stock?
Well, I'm cheating slightly with my second stock because it's not. Well, it has had a result recently, but it was pretty dull. Medical Developments International, which makes the green whistles, which you puff on when you've dislocated your shoulder or what have you for pain relief. If people haven't had the opportunity to use one,
Or for possible RSI when writing all those positive MoneyMe reviews?
yeah. Well, there you go.
Or
So
the stress of building leaks and
Indeed.
so they had a look at the result. Is really neither here nor there. I mean, they performed very well in Europe, which is great to see. Except that I mean, look, it's against a sort of COVID affected period, so it's although so was this one to a degree. It's hard to sort of compare, I suppose, year to year. But they've got their sales teams. They're sort of busy sorting that out in Europe and particularly France, and prospects look pretty good there. But prospects look even better now in the United States. So, well, compared to what they were, the the big news came out a few days after the results, where they announced that the clinical hold, it's called, on the trials in the US has been unconditionally removed by the FDA, which means they can go ahead and start recruiting for that trial, which they'll do later this year. They've already done quite a lot of the preparatory work, apparently. Um, and the fact that it's unconditional means they can bypass one or two other things in terms of getting the thing off. That they were expecting to have to do something called a human factor study. I must admit that I do you know what that is, Graham? The but they a preliminary study to the trial they won't now have to do, so they can get into that straight away. The trial will run for 2 years. It only requires them to have 200 users, which seems extraordinary, and possibly um, reflects the safety profile that's been established for the product around the world. Um, and so they're hoping to start selling in America. I mean, look, they're not yet. We'll have to wait and see if the trial is successful. But we have good hopes for that because of the safety profile around the world and efficacy. And so they're hoping to start selling there in the 2026 financial year, which sounds like a long way off, but actually, the beginning of that financial year is only a bit over 2 years off. Um, so we'll see. But um, certainly getting that approval, which is, again, I say it's not in the bag yet, but this is very much a step in the right direction, and that's another huge market. Which the way management expressed it on the call was, it's another leg of growth. Excuse me.
Sounds
After
like
the Europe,
you might need a green whistle there, JC.
Europe should be growing strongly the next few years. That's certainly management's expectation, and they're describing this as the next leg of growth after that. We're keener on the stock than we were before, and yet it's funny because after the results, so when it went into the trading halt ahead of that, the stock was at 340, and then it bounced to 460 when it reopened.
Yeah, I remember there was a big move that
huge
day.
30% move that day, but then it went all the way back to 360 or 70 yesterday, but it's bounced a little bit. But look, it's cheaper than than it was 6 weeks ago, and yet it has this this clinical hold lifted in the US. One has to say it's a one product company. It's a one product pharmaceutical company which doesn't have full approval, which is still doing trials in its major market. And so, pharmaceutical products, there's potential for recalls, all sorts of things. So it's a speculative buy for up to 3% of portfolios. But we think that, there's the potential for, the potential more than makes up for the risk for that small part of portfolios.
And this is another one where the management's great. A bunch of ex-CSL execs.
Yeah, that's right. Actually, what I was going to say that possibly the main thing that came out of all this, apart from the obvious approval for trials, is how impressive the management are, and they, I just their that presentation is on the Medical Developments corporate website, and if people are interested, I encourage you to go and have a listen because they're pretty impressive.
I haven't done that yet, but I will do. Thanks. I think this is it's looking quite interesting. I'm surprised by these share price moves actually.
Well, I think it's this thing. If people see that share prices going down at this current point in time, grinding lower day after day, a lot of people are put off from buying.
Yeah,
and that means they can keep going for a while.
All right. Well, let's finish up my last stock, which is I thought we just very quickly just look at Lovisa. Just run through what I liked about the result. But I wanted to give a quick shout out to a couple of other brilliant results over the period, which came from BHP, just astonishing. Aussie Broadband, which was just phenomenal as well. And Karoon Energy, which just, geez, that thing is going to be printing some cash. And the other one is Woodside, which probably is going to look even better in the next half and in the year to come. But there are some very, very strong, solid results coming through. But Lovisa was a good one. Lovisa stood out to me because, retailers across the board had been reporting cost issues, supply chain issues, distribution issues, lower demand from consumers. And you looked at Lovisa's results, and none of that was evident in their result at all. They just crushed everything, despite having the Omicron mess on the East Coast, on the East Coast stores. There's such an international business now, and the rest of the world just covered for those losses. And there's so much more growth potential. So the margins are actually fantastic. Sales growth was incredible. They're continuing to get so much product out to stores and continuing to use all the data that they generate to create new designs to get out to stores. I think they do about 100 new products a week and get them all done and delivered to stores, which is an incredible feat. And the US expansion, they're only at 80 stores in the US. And as I said in the review, I think there's room for thousands of stores in the US. The question about the model, the actual economics of the stores, there's not really a question about that anymore. It is now about how many they can roll out and what this thing looks like at greater scale. So I think that was just That's just a phenomenal result. And the market's not unaware of it. It's one of those stocks where the PE looks pretty silly. I think it's anyone got that handy? You got the PE handy for Lovisa, JC?
I've no idea, I'm afraid. It's a lot, I think, isn't it?
All right, let me get it for you. It's about 45, 46 times, which is a lot, yeah. But when you factor in the growth that's coming, look, we don't have a buy on it at the moment, and I think that's probably right. But I certainly, it could if it gets hit during this period. This is a business that has a fantastic management, a long runway, and probably the best retail economics I've ever seen. So it definitely one to add to your watch list if it's not there already. Well, gentlemen, that was a big podcast.
Right, lots to talk about.
Lots to talk about. Yeah. We could go on, but we should probably finish it off at some point. I can hear
Gonna
birds
finish up
screeching
one or
in the
two
background. Who
results.
is that? Is that
Yeah.
me or is that you guys?
I thought that was at your end.
I think it is at
There's
my
some
end. I've got
bird. Yeah,
a
yeah,
cockatoo nest
yeah.
not too far from me. It's very loud. But thank you for joining me, JC. It was good
Pleasure.
to hear from you. Graham, likewise, thank you for your time.
Thanks, Gaurav.
And for everyone else, thank you for listening.